it's still kind of hot.
Nice. I feel it, man. It's getting hot here too. I mean, you guys are getting probably hit a lot more than we are by any means, but it's kind of crazy. It's only springtime here, and it's like 80, 90 degree days already. Like it's getting pretty
Yeah.
crazy, which is cool. You know, we have the flowers already. Like we have like we need flowers because of the bees. So like we've already have like flowers and stuff, which is crazy. Like we shouldn't have that this time of year, but it's awesome. Um, but yeah, so we're here with Kashop. This is the market report. Just generally talking macro markets, you know, a big top down view. I had somebody talk to me the other week, and the conversation was very interesting. And they were like, "Well, you know, I like what you do, but I'm just not into commodities." And that's fine. Like I'm not saying you know everybody needs to be into commodities, but to understand markets, you have to understand commodities. If you're going to trade, be a cyclical trader, meaning you know you go from buying technology to buying gold miners to buying utilities, to buying commodities, bonds, whatever. If you're going to look at trading like that, you really have to have an open mind to be very open to all of these different things and understand how the commodities can put pressure on each market. Not to mention, you know, look at energy. Obviously, energy and oil. We all know that. That's very simple. But look at it in a deeper way. Something like technology. Oil could go up, putting too much pressure on technology. Same with the gold miners. Oil could go up, meaning higher input costs for gold mining companies. I mean, it's endless. So really, you have to understand. Number one, you have to understand oil. Like whatever you do, you have to understand oil. Oil will help you in any type of trading environment you want to be in. But number two is understanding that, hey, gold's going up, bonds are kind of flat. What does that mean for the market? Well, you could say the market's in a risk off type of tilt at the moment. You know, it's kind of tilting more risk off than risk on. Because Shop and I have been talking about this, you know, the reflation trade moving into a stagflation trade. We've been talking about that for a while. And now kind of seeing, okay, well, gold has kind of been hinting at that for a while, very easily. We could see some other things move up. It could be saying that bonds could move higher. It could be saying that commodities could move higher. Most of the time, the way the market works is gold kind of rings the dinner bell, meaning, you know, think of 2020, for example. Gold starts to make a big move. Then you basically have at the end of the year in 2020, after the November election, that's when all the commodities started to move. That's when you get these crazy breakout signals. We were long every single commodity into the end of that year. And gold kind of rang the dinner bell to say, hey, we're going to start moving into all these different areas, inflation wise. Everybody expects gold to move with the commodities. It's just not true. It's just not the way it works. Even though gold can move with the commodities, it doesn't always do that. Sometimes it's just what I liked about it in the last few years is that gold, if you just had it in your portfolio, it still did a lot better than a lot of things in 2022. Yes, it came back. Yes, it didn't just sit at the all-time highs, but it just chopped around. And sometimes your best trade is something that's just holding its value over time. Now it's moving back to the upside. What's that exactly saying about the commodities? I could say a lot of things about that, but we'll get into that today. How you doing, Kashop?
Doing great, Jason. How are you doing?
Good, good. So, you know, we talked about it today. We're going to talk about some ags. Well, we'll skip into some other sectors. I have some charts coming up later with Steven.
So,
Just looking at a bunch of 52-week highs, you know, just to give you a little hint what's coming. You know, we got gold miners 52-week highs. We got utilities 52-week highs. We have consumer staples at 52-week highs, and a couple other sectors starting to hit new highs. That's very interesting, especially because also recently energy also hit a new 52-week high. So
I
what
did not know
exactly
that.
does that mean? What?
I did not know that. I did not know utility staples and energy all hit 52-week highs at the same time. That's crazy.
Very odd, very odd. You know, it's one of those things that I would say I don't know if I've ever seen that happen. I've been studying the markets, and that's what I do really. What I do is I'm not as good of a fundamental analyst as I am of a technical analyst, but also my systems and my algos that I run. So I run all of these things, but at the same time, what kind of helps me to dissect the markets and trade these markets well is an understanding of history and how the markets move throughout history and what sectors do well at what times and how they do move. And because they do move in such a way, normally I can pay attention to those things and go, this is what usually happens. But energy making a 52-week high, and then utilities, staples, and gold miners making a new 52-week high all very recently. That's I don't know if I've ever seen that. There are environments like stagflation is an environment where you do see things like that happen. It's very rare, but it does. But it's kind of leading way more to the stagflation thesis. On my macro models, does it say we're in stagflation yet? No, but the price action always predicts what's going to happen. And so the price action is also looking forward, just like we're looking forward and going, hey, we're probably headed into a more stagflationary environment. So, Kashop, what are you seeing out there in that, just to add a little context to that before we get into the ags?
So I actually am quite surprised because I would have thought utilities and staples would be doing absolutely terribly in this environment. So it's very surprising to me that they are at 52-week highs. What I'm seeing is exactly what you pointed out. It's stagflation everywhere, except maybe in bonds, because bonds seem to be going counter to that. Maybe that's temporary, maybe that's signaling something different. But that's the crazy part of this market, where usually when you have commodities pick up, you would see tech start to kind of stall a bit, but we are not seeing that. We are just seeing it's like an everything bubble all over again, where everything just keeps going up, and we don't even seem to have that many down days, and the corrections are rather mild, which is very surprising given how much of an effect liquidity is having in this market. So a week where bank credit is contracting, you have a down week, but it's not that pronounced, and then when it recovers, it just recovers straight. We don't usually see these kind of smoothly trending markets. There's usually a lot more chop, something that worries traders, worries investors, and right now we have none of it. If you had energy bull, you just wrote this correction and it was pretty mild compared to the corrections you wrote earlier. If you're a gold bull, the miners barely even blipped. So not even a 5-10% correction even in the small miners, which is very surprising. Same with copper. It's just straight up. And I think the only place where you're seeing a bit of back and forth, I guess it comes back to agriculture, because the agricultural commodities, I think they have been pretty late to take off. I think wheat was first, and maybe no, oats was first, and then you had wheat take off, and then corn, and then soybeans. But they all seem to have come back a little. So, is this what you would consider normal price action for the softs? Because I think that's the only place where something looks normal and not just a smooth uptrend. So, what do you see in the space? Like, what are your thoughts on corn, soybeans, wheat, and oats? What are you seeing there?
Yeah, I mean, for us, we had the signals kind of all come in at a very they were all within 5 days of each other. You had first, I think it was wheat. Wheat came in first, then it was corn, and then soybeans, which I didn't know if that would actually pick up because the fundamental picture for soybeans isn't nearly as bullish as anything else. However, when you look at the ags, like this is why the price action is always king. One, we get paid by the price action, but also it tells us that most of the time when one of these moves, most of these move, and most of these ags can move together in a very large way. And so you don't want to just go, hey, corn looks good and all, and I'm going to put all my money into corn because they said that, hey, there's going to be less corn acres out there. That could be true, but at the same time, the reports are going to come out and they're going to say, okay, we're gonna plan for them to start planting more soybeans going forward. And then the next report could say, hey, guess what? They didn't plant as many soybeans going forward, so therefore this is going to happen next. This is what kind of creates this ebb and flow effect between the two commodities, like soybeans and corn. You'll have soybeans start to move up in a huge way, break out, and then all of a sudden it'll be flat on this type of report. And then corn will start to move up in a big way, and then it'll be flat because they said there's going to be less acres, but there's not nearly as it's not the same number that they were expecting. So the expectations kind of run back and forth. And so I think it's important to just, one, I think as the buy signals come in, you just got to take them. It's kind of like when you're looking at, technology and energy. We were long technology, and when we got the energy signal, we still went long energy. It's not that I'm more bullish on one or the other. It's that the signals are coming in. I'm going to just continue to take the signals as they come through. And that's most of the time, that's the way you'll make money. Now, my forecast can also tell me that I should probably be shifting more into energy, and that's going to happen. But also my price action is going to take me out of the things like the technology stocks when they start to actually come back. For now, they still haven't given a sell signal, which is very surprising given the environment. But that will kind of keep me in that trade or out of that trade. Now, it's the same thing with soybeans, corn, or if you look at oil, heating oil, gasoline. Yes, all these can move together, but I think the better way to trade, now it all depends on the size of your account too. If you have a decent size account, you can trade this way, meaning your account's big enough to where you can make all of your positions even smaller. So highly correlated things like corn, soybeans, wheat, highly correlated things like heating oil, gasoline, and oil. You can kind of go, okay, well, I'm going to have smaller positions in each of these because these are all going to probably move close together. But at the same time, you don't know what's going to happen going forward. I've had plenty of times going like, hey, heating oil is the best trade out here. And then heating oil was the one that crapped the bed the quickest, like that happens all the time. And so also I've had years in the past where heating oil is the one that just makes the biggest move. And, that was recent. I think that was in 2021. Heating oil made one of the biggest moves while oil and gasoline did well, but they didn't do nearly as well as heating oil. So I think the same thing, I would do the same thing right now in trading, which is, hey, take small positions in all three of these things: soybeans, corn, wheat. Historically, you could look at it and say they're undervalued. And but there's plenty of easy ways to do valuations on commodities. So I'm not saying undervalued as in what I'm thinking or just being cheap in price. I'm saying they are undervalued in supply and demand numbers and so on. So, and any future projections. So looking at those, I would still be long all three of those. I still think there's a lot of upside. I think wheat absolutely is probably the easiest one to continue to buy whole and see where that one goes. After that, I'd go corn and then soybeans in third. Honestly, wheat and corn, there could be interchangeable here. I think globally, wheat is the way to go. But in the US corn is probably the easiest one to buy right now. And then I'd go soybeans last. However, buy all three, take small positions, size them properly. I always talk about sizing trades. Like sizing trades is the most important thing in trading. It's more important than picking the right thing. Sizing your trades properly is everything.
So I get the trading aspect, but so I know you also work with farmers directly. So when you're talking to the farmers and they are seeing this price action in corn and soybeans and wheat, so what do you tell them? What are they planting? What should they be planting? And how do they think about it? Because it's going to be a good 1-2 harvest for them and then they rotate. So how are they going to react to this price action?
No, I love that. That's a great question. So what I always suggest is every year when the projections go, hey, everybody's going to be moving into soybeans, I always say, hey, probably plant more corn. Now, once again, sometimes you have to rotate crops. And when they do, that's just something they have to do. They've already planned to do that. I'm not going to change that. It's for growing purposes and so on. But when it's not for those reasons and it's because they're chasing the one that they think is going to be the best, make the most money, I say time to move, time to do the opposite thing of what the herd's doing, because most of the time that's the one that's going to be the most profitable. And also, you'll see these spikes, and they'll be able to sell into these spikes as they feel these projections are coming in. So, for example, if you see a spike in corn, this is when I would say to make cash sales. That doesn't mean for me as a trend trader, I'll go, hey, I'm going to start selling my position. It's as a short-term trader, you could sell into strength. As a farmer, you could start making sales, because guess what? You're a farmer. You have to make sales. You could start making sales. But also, I do suggest other things like, hey, we're in a commodity run right now. You know, corn is continuing to fall in price. I wouldn't sell it right now. I wouldn't even sell the spikes right now. I will say that at times. Now's the time where I'm saying, hey, you know, you could sell basically around, I think last week I talked to the farmers. It was, hey, make some cash sales if you want to here, but I would still prepare for more upside. So maybe sell half, maybe sell it. Just it works very similar to trading, you know, but more like a risk management, vol targeting style of trading, where instead of selling everything, you're just going to sell a little, take a little bit off the table. Hey, you have to make money. You're a farmer. You got to feed your family. But at the same time, if you can hold on, wait to make sales till a little bit later. And also you can hedge too. A lot of them hedge by buying futures. Hey, we're seeing a major trend that could move up in corn, in soybeans, in something. So continue to buy futures. We're going to wait till that moves up, and then you can sell your product while you're actually holding on and making money in another way. So there's a bunch of different ways to do it as a farmer. I think it's really fascinating to just kind of see what they see, because a lot of the time they're, you know, it's just like the producers for any commodity. You're able to kind of see exactly what they're thinking, how to think about it, and why the price is moving the way it is. You know, sometimes you'll see these crazy spikes, and you'll talk to farmers, and everybody will be like, look, I believe, I don't even care what I'm saying to them. They don't care what anybody's saying on TV or anybody ever. They just have an opinion that it's going to go a lot higher. So they're all of a sudden the supply will start dwindling, because they'll just be holding on and loading up at the time, and you'll just see the prices just rising and rising and rising. And most of the time, they're not the people who are going to continue to buy on the way up, because the goal is to hedge their product. So as their goal is to hedge their product, as the price is dropping, that's when they're going to buy futures. They're not going to buy futures like I buy futures when I'm looking for breakouts and stuff. They might be holding on to stuff at that point. So there's a bunch of different ways to look at it. I always think it's kind of cool to just kind of take a view through their eyes and see what they're seeing.
And so, what are they seeing with respect to fertilizers? Are they seeing, are they stocking up? Are they seeing price increases coming? Because natural gas is a big part of the fertilizer input cost. And right now, we've gone from around 1.6 in natural gas to roughly around 2.2, 2.3. And so that's going to start moving fertilizer prices higher. So, do they see it that way, or is that is there a very trader perspective where when we look at everything, that's the macro picture we form? But is it similar for farmers, or is it different?
So it's very similar, and that's a good point, because they're always asking about natural gas. They're always asking about fertilizer, and they're always wondering, what exactly would be a good time to buy or sell. The problem that they're running into is that there's a big difference in what companies are charging compared to what their input costs are. Yeah, and you know what that means, but just to explain that a little better for people who might not. What that means is when you're looking at, when you're going to Walmart and you're looking at steak, and, you see, let's say, cattle prices are moving down, and they've been moving down for months, but at the same time, your steak prices at Walmart or something, or Kroger, continue to go higher. That's something that's where that disconnect comes into play. So it's the same thing for fertilizers for them right now, where yes, they're looking at fertilizers and going, hey, the futures and these prices are starting to come down a little bit here and there. They came down last year, and but instead of that getting passed on to the consumer, they're just not seeing that yet. And it's the same with anything natural gas related. Even though the price came down so much, they're not seeing it in their input cost, as a consumer. So once again, it's a really tough thing for them to deal with. But also, a lot of them do buy natural gas futures. A lot of them do hedge by buying natural gas futures and stuff like that. But what's kind of funny is they do trade that more similarly to me, because that's not their product. That's not something that they make money doing. They trade it kind of based on a breakout style, like, hey, it's moving up, we're going to continue to buy. I think that's why there's sometimes this big disconnect in what you'll see in natural gas COT reports compared to natural gas prices. Because the rest of the COT reports, you'll see that the commercials or the producers start buying on dips, and natural gas, sometimes you see very weird like spikes when the price spikes, and it doesn't happen all the time, but it happens sometimes. So I think that's kind of interesting, where you can kind of see the producers buying in very weird times. But I think it's because one is hedging their product, and the other part of it is buying something to try to hedge something that they have to buy personally. So there's a couple different ways to look at that.
That's really interesting. So the other question I had was, so I'm seeing ethanol futures are moving up. I'm seeing corn futures are moving up, but sugar kind of seems to be stuck. It's just in limbo. It's bottomed, but it's not headed higher. It's not headed lower. It's just kind of seems to be stuck. So what's up with that? Because you have corn moving, you have ethanol moving, and nothing in sugar. Is that common? Is that the way it works?
So I think there's a couple interesting things there. So let's just unpack that a little bit. One is, what we think the market should do is always the opposite of what it usually does. And this is why I really stick to my guns on, like, hey, I'm a breakout trader. Hey, this is how I trade, because I see that it always shifts, and things shift so much. There's no fundamental way I can really go, hey, sugar, ethanol, and corn should move together. Sometimes they do, sometimes they don't. There's just so many different supply and demand dynamics. And also, Trader Vic had a great one, and I'll maybe reshare that interview. But when he talks about anchovies, and he talks about something fundamentally changing out there, and it's showing up just in the price action, and you can't see it fundamentally anywhere else. But what the price action is telling you is that something has changed. And so for me, do I think that sugar is going to stay down here and it's not going to catch back up again? And it's going to be unable to, start to catch up to the rest of the market? No, I don't think so. But I do know that sugar generally makes its big runs at certain times of the year. Later in the year is usually when it makes its big runs. Usually it's based on planting too. So very similarly to ags, like corn, soybeans having runs into summer and into fall. Sugar will be on the opposite end of the spectrum, but it's also mainly produced below the equator, in different parts of the world than the ags are produced. So once again, there's just totally different supply and demand dynamics that you have to think about to just kind of put together a trade like that. So for me, sugar, I'm not really touching it. If it basically it would have to break above. Right now, all of our signals are about the same. It would have to literally break above $23.17 for us to even get a buy signal. So it just kind of continued to move lower. We did have a false breakdown signal at the beginning of the year. It came in and went in days. It looked like, actually, it looks about 2 weeks. So the signal came in. It ended as slightly profitable, but it came and went in 2 weeks. So, sugar, however, the fundamental picture for sugar looks really good, but it doesn't look as good as everything else. Now, when we look at coffee, I look at coffee and see and that's also another thing that's kind of produced, and you'll see that coffee and sugar sometimes work very similarly. because they're both grown in very similar places, similar climates. So you'll see that sometimes the softs like that will start to move very similarly. Softs, for people who don't know agricultural commodities, well, softs are cocoa, cotton, orange juice, coffee, lumber, and sugar. And so some of the softs like orange juice, coffee, sugar, they're grown, cocoa even, they're grown in very similar places. So sometimes you'll see very similar trends. They're not as highly correlated as the ags by any means, but coffee kind of has the setup very similar to a cocoa, not anywhere near that extreme, but could continue to move here. I think it came back recently. It's still moving nicely. It's still up nicely from the beginning of this year. However, it had a nice pullback. Probably a good add point would be around here, actually, for commodity traders if you are looking to add. Commercials are starting to step in again, so the coffee's looking good. But back to sugar, we're starting to see a major commercial buying in sugar, something we haven't seen from sugar in a long time. We haven't seen these numbers in sugar since, God, that's before 2022. Let me go back further. We haven't seen these numbers in sugar since 2020. So right around that bottom in 2020 is the last time you saw commercials buying sugar, meaning the producers. So the producers are now buy sugar at major levels. This usually puts in significant bottoms. So once again, while I'm not seeing anything significant on the front of, hey, sugar is doing this, this is why we'd buy sugar, I am saying just from basic COT models that I've built over the years that this is a good time to start looking at and taking buy signals in sugar. I would continue to wait for it to cross those major levels, but sugar absolutely looks like a good buy here. Comparing it to ethanol, though, and corn, it's very hard to do. Those disconnect all the time. And ethanol, I obviously know how it's made, but I don't really put too much effort into trying to predict ethanol. It's also one of those things that just kind of moves in its own way. There's a lot of politics involved with ethanol. I've never traded ethanol. I don't know if there's even a liquid enough product to do so. But once again, you'll see that there's major moves during certain periods of time. It kind of does move with corn a lot too. But I'm not sure why there's that big disconnect at the moment between sugar. But I would say corn and ethanol is something to always kind of pay attention to because both of those kind of move together.
So there's a fundamental reason that it's very interesting that you point out the commercials are buying sugar, because about 10 days back there was a news article in the Australian saying Wilmar's sugar mill in Australia is going to get hit by a worker strike. And that's the mill that's responsible for 50% of Australia's processing capacity. So if there is an outcome like that, then I can very well understand why the commercials are buying sugar. So
and they're also buying ethanol too. I noticed that too. They're buying ethanol like crazy at the moment too. Even though the price has moved up, they continue to buy. That's also kind of a rare event. And it's the same with natural gas. Like even though natural gas has been moving up in price, the commercials are still buying natural gas like crazy. So it's those developments like that are always significant. That happened in lumber a few years ago. And you remember this trade I had a few years ago in lumber. We had a really great trade, and the commercials continued to buy the whole way up. And it was very soon. I think if I'm right, let me go back. I think if I'm remembering right, cocoa also did something similar recently. Yeah, so basically cocoa started making its run in, I think that was November 2022. Yeah. So November 2022, and it was just in a steady uptrend for a while. Very steady, not parabolic, very sustainable, moved all the way to 3,000. Then once it got to the point of 4,000, you started to see commercial buying starting to pick up like crazy. And so you'll see that sometimes. Sometimes it's an end cycle environment where everybody's chasing. So you really have to go through the numbers and see how many commercials are buying, how many hedge funds are selling, are these true numbers? Because the way they work, because every future contract has a buyer and a seller, you'll see that the lines are always inverse to one another. So you really have to dig through the numbers at times. But if you figure out that, yes, commercials are really buying the hell out of it, yes, the hedge funds are selling the hell out of it, then you actually do have a good recipe for to continue to stay long something. So cocoa was the same way. I could see natural gas continuing to move here. I think it's in a very interesting place. I think a lot of people wrote it off, and once again, everybody talks about it being the widowmaker trade. It's a widowmaker trade. It's gone up. It's gone down. It's just another trading vehicle. It's volatile, and people don't call cryptocurrencies, the smallest ones, the widowmaker trade. And I'm sure more people have lost money trading those, and they're much more volatile. So people don't call that the widowmaker trade, but they do call natural gas the widowmaker trade.
Yeah, no, that's true. So, coming back to ethanol, so do you think the commercial buying or these moves have the blending requirements for the summer driving season? Has that been set? Is there a possibility of a surprise there? Is that why it's moving? Could there be a fundamental reason for those moves?
I think so. I mean, I agree with that. I mean, for me, it's not that I don't pay attention to the fundamentals. I do. I'm just mainly stating, what I see on my models most of the time. So
No,
even the
like I know you
article,
follow the fundamentals on the blending of the fuel as well, right? So,
yeah,
are you seeing anything there? Any difference? Anything that could be driving this, like potential
I think you're
factors?
absolutely right. Where it is involved with the summer driving season. As it's warmed up early, I think it's kind of very interesting to see when a lot of these bottomed was the same time it warmed up early this year. We had a very early spring across the board in the United States. If you look at natural gas, it bottomed in late February into March. We were already having flowers starting to bloom at that point in Ohio. I'm in Ohio. It should be snowing and nasty, and flowers are already out. We didn't even get to ski this year because there wasn't enough snow to ski. Um, and then when you look across the board, it was very similar to ethanol. Ethanol also bottomed the beginning of March. And then, but also if you're looking at, oil, also that started to move like crazy around that point, but then it's pulled back a bit. I think oil being a very political thing too, very similar to the way I talked about ethanol. Oil can be driven by politics quite a bit as well. I still see fundamentally oil has a lot of upside to go. Now, I know a lot of people will disagree with that and have their own reasons for it, but I don't see a reason to say, hey, oil's going to go right back down to 70 and that's it. I think if it was due for a pullback. It had a great run. Pulling back, getting back to that 70 level, that would be surprising to me. I think they wanted around that $80 level. Speaking about OPEC, liking it around that $80 level, 80 to 90 is very profitable for them. I think they'll try to keep it there. However, I think the thing to keep paying attention to, and the thing that everybody isn't talking about anymore, which is very interesting, I don't know why or when that happened, is the dollar. You and I always talk about it, but nobody's talking about the dollar in the last few weeks. I don't know if something happened or if people just got bored with it, or if I just think about the dollar too much. It's one of those things. But looking at the dollar, I would say the dollar could be topping out right here, right now. And I know, a lot of people are looking at it. Hey, the dollar is going to break out. It's going to be a new uptrend. Then we're going to see hyper deflation. It's the end of the world, and the bonds are going to go crazy. And it's the thing that people continue to talk about. But really, I think the dollar is still, it's one of those things when you look all over the world right now. So let me go to my country stuff. When I go to look at the country indexes, and we look at, all over the world right now, year to date, what's in first place? Peru, Argentina, Canada's up 4%. Then we go to Europe, Greece, 13%. And I'm talking about the things that are above the United States. Greece is at 13%. Ireland's at 13%. The Netherlands is at 13%. Italy's at 12%. Denmark's at 10%. The UK is at 9.5%. And then if we scroll down, we see Turkey. Turkey's up 27%. That's pretty interesting. Turkey up 27%. And then if we go to China, China's up 8%. Taiwan's up 7%. Japan's up 5%. So I mean, and yes, some of those were under the United States, but I'm just pointing to what's going on in Asia. It's very interesting to just kind of look at what's going on around the world right now, performance wise. And most of the time when I see that, and most of my trading is based on my past results. So if I'm looking at and I'm back testing things and I'm going through it deeply and I'm going, okay, well, if we look at Asia, if we look at this, if we look at China starting to move, what usually happens to the dollar? And usually the dollar ends up starting to pull back a bit. And the dollar has been strong. It's been stuck in this range for a long time. This would be good for everything, honestly. And I don't think there's any reason that anybody, global central banks, I don't think a strong dollar is good for just about anybody, even including the United States right now. I don't think that's good for anybody. And I think that's part of the reason why, and it might be part of your thesis too, and you could talk about that a little bit, which is why the Fed will probably cut. I'm still stuck on the fact that they probably need some form of a catalyst. I know you were writing about this recently too, about the Fed and cutting rates. So I'm wondering, if we're looking at the Fed and we're going, hey, they have to cut for many reasons here. Do they cut because of the debt? Do they cut because of the dollar? Like, what is that reason? And also, how do they do it if the market's this strong? So are they going to blame it on some form of a catalyst? I think it comes from a catalyst, and I don't think that has to be market related. I think that could be related to anything. So, what are you seeing from the Fed here? Do you think they're going to cut? I know you wrote about this recently. Talk a little bit more about that, because I'm interested in hearing what you think about this too.
Sure. So I am firmly in the camp that they are going to have to cut. And the reason for that is, one, it's an election year, and everyone might say, like Neil Kashkari, I think, just recently came out and said, no, we will not cut in September. We will. And Powell was point blank asked this question at the last FOMC, whether there's a difference between cutting ahead of November or after the results. And he took a long pause and he said, that's not the way we work. Like, that's not a question you should be asking us. And if that's the way we go, then where would it end? So he kind of went along that path, but you could see that question made him quite uncomfortable. And that's understandable, because you have Trump saying that when he becomes president, he is going to make sure he has direct control over interest rate policy, and they're trying to already drum up some support for that point of view. And then you have Biden saying interest rates are headed lower. And right before the December FOMC, in fact, the same day Powell was scheduled to speak, Janet Yellen came out and said interest rates are going lower. It was like within a few hours before Powell was scheduled to speak, she just came out and said that. So that was a complete shocker, because I can understand this in any other country where the central bank policy is only important for that particular country. Like Iceland went broke. No one outside of Iceland and maybe some Deutsche Bank shareholders really cared, because it did not matter. They just went heavily into banking, and then they went back straight to fishing, and it didn't have much of an effect on the world economy. But when United States does something, it has ripple effects all over the world. When US does QE, everyone is kind of forced to do QE, because all the other economies are mercantilist and they can't really afford to have a stronger domestic currency. So they do QE. And when the US tightens, they don't really want to let their currency devalue massively, like what we are seeing in Japan. So they are forced to tighten. So whatever policy the US adopts, every other central bank kind of has to toe the line and adopt the same policy, because the dollar is that important. So when you see all these moves in the dollar, so I think you're right in terms of the dollar has peaked, because all the drama that we are seeing, I think it's not sitting well in the circles where all these decisions are made. So that's point number one. And the other point is that the one reason Powell gave for cutting rates is labor market weakness. So he said, if we see unexpected labor market weakness, then the rate cut will be accelerated. So the timeline will be pushed to the nearer months. And that's exactly what we saw with the last jobs report. So we saw unemployment go slightly up, which, the way these consensus estimates are made, it's obviously all known in advance, but they engineered it such that everyone was shocked. So the news says we are shocked by this labor market weakness. So that coming within a couple of weeks of the FOMC tells me that it looks like it was engineered to actually result in that print. And if that's the case, now the Fed has cover. So now all they need to do really is to take oil and gasoline a little lower. And if they can succeed in doing that, and they have the cover to cut rates. And the way they would go about cutting rates is they would say that it's going to be good to bring down shelter inflation. So they already come out with new metrics on that, where they're saying this much is owner occupied, this much is rented, and if we have to bring down shelter inflation, we have to bring down the mortgage rate, so rents come down, all those factors. So they'll use all that as an excuse to kind of cut rates. But the other point that I look at it this way, like, first of all, so I got last March the whole deflation thesis completely wrong. So I was expecting a huge deflationary crash because of, well, you had a banking crisis, you had three banks failing in a stretch. So a banking crisis is deflationary. That's the definition of it, because credit contracts, and you did not have that. And when I went back in history, so what I saw was the bank term funding program kind of stabilized everything. So you had the unwind of QE in terms of the Fed balance sheet was so rapid that that liquidity injection led everything to spike higher, even though overall credit didn't really grow as much. So what we saw there was, you could have had what Ray Dalio calls a beautiful deleveraging. You could have had that where some VCs would have gone broke, which, considering the model is a venture capitalist model, so they're supposed to go broke. Instead, you had this whole inflation wave. I think that's where the inflation wave really took off. And you had all these bubbles and Mac 7, AI, you had all these new themes take off, you had Bitcoin, crypto take off in Q4. And what we saw is that the high rates are kind of hurting real estate, hurting mortgages, but it's not really hurting all these other sectors. And why is that? And that's also because it's not just the rates that matter, it's the liquidity. And what we are seeing is that liquidity has constantly been going up since the Silicon Valley Bank crisis. So liquidity in terms of, if you look at bank credit, bank deposits, it's all going up. Fed balance sheet, not so much, but they created this reverse repo, which is kind of like a reserve that they are now, think of it as money that's outside the economy, which is like stashed away, like what gamblers do when they want to not gamble those funds. So they kind of had that stashed away from the banking system, and now that's getting converted and coming back into the real economy. So that's all these ways that they are getting liquidity into the system. And then you also have the treasury, which is, instead of financing at the long end, meaning issue 10, 30-year bonds like they usually do, they are issuing short-term debt. So by doing that, what they are doing is they are draining all these excess reserves from the banking system and putting it into the economy. Because in a situation where the Fed isn't buying treasury bonds, let's say the real economy, the savers have to buy the treasuries, then every dollar that a saver puts into treasury bonds is a dollar that doesn't go into commercial bonds, doesn't go into the other investment grade bonds, doesn't go into the private credit market. So instead of that scenario, what you're seeing is the treasury is taking money out of the banking system so that private credit can continue to grow. So you have all these neat little tricks that are being played, which is getting liquidity back into the system. But these kind of situations, there is a logical endpoint, because there's only so much you can grow credit without growing the Fed balance sheet. And I think it's high time. I mean, I think the Fed knows this, everyone knows this, and I think they're probably just going to have to cut rates at least a little bit so that first they need to recapitalize themselves. So the Fed is now technically bankrupt because it bought all these mortgage backed securities and treasury bonds when interest rates were much lower and yields and price are inversely correlated. So when the Fed raised rates this way, so they are actually bankrupting themselves because they hold so much in treasuries which are yielding a lower rate than the current Fed funds, the current yield curve, in fact. So if they have to get themselves out of this mess, they have to cut rates. And second, all the banks, so the problem with the banks is one, yes, of course, you have very poor lending standards. So they are lending money to projects which they should never have lent money to. But the other problem is when the Fed printed so much money in 2020, all that money went into the system. So all of that circled back as bank deposits. Now, when the bank is holding so much in deposits, what do they do with that money? They can lend it into disastrous CRE projects, which is what they have done. But a lot of it went into treasuries because they thought treasuries are safe. It's issued by the US government. So let's take all this depositors' money and keep it safe in treasuries because the banks grew in a rate that they had not expected to grow. So when their deposit base ballooned like that, they had no choice but to buy something and they chose to buy treasuries. Now, all those treasuries are sitting on their balance sheet and the value of those treasuries has declined. So now they are in a real dilemma. And because all these bank issues are coming to the forefront and because yields are much higher, investors are taking money out of bank deposits, putting it into treasury bills, putting it into other instruments, chasing the max 7, whatever they are doing. So now they are in a situation where they have all these treasuries and they have calls on that money. So depositors want to withdraw. So they have to sell something. But if they sell something, they crystallize a loss. And if they crystallize a loss, then their equity goes for a toss. And if they dwindle their equity by reporting losses, then people panic, and that's how a bank run happens. So you have the banks kind of in a bad situation, and the only way to save the banks is to save them from their mistake of buying too many treasuries. And the way to do that is to cut rates. So however you look at it, without rate cuts, none of this is going to work. All the temporary measures that the Fed is doing, the Treasury is doing. So, Treasury recently announced a program wherein they are buying back the treasuries that they issued and funding that by issuing more treasuries. And it sounds like a circular thing, but the way it works is, let's say they issue 10-year bonds and buy 17-year-old bonds, basically bonds which were issued as 20-year bonds, but now they are 3 months into their maturity period. So they are buying those bonds. So by targeting these off the run bonds, that is the bonds which aren't the neat little 10, 20 numbers, what they're doing is they are bringing rates down all across the yield curve. So when they are doing that, they are kind of helping everyone with their mark to market losses. So it's a good trick to play and it probably works for a while, but it's only temporary because if you really want to bring the yield curve down, there's only one way, and that's bring interest rates down. I mean, there are two ways. The Fed could do yield curve control, which is basically targeting, I'm going to buy 20-year bonds, I'm going to buy 30-year bonds. So something of that sort, which is what Japan was doing. So they have those choices, but ultimately it all comes down to lower Fed's fund. And I think they have no choice. So one way or the other, they're going to have to cut. So what I'm seeing is right now they're trying to not cut or delay the first cut because they don't want to be seen as political. They don't want to be seen as helping Biden win an election. But maybe if not September, right after the results are announced, I'm pretty sure they are going to cut. And maybe they don't even last that long. If labor market weakness starts to become a thing, then they may want to get ahead of it and cut anyway. And I think all they are doing is looking for excuses to cut, looking for ways to keep this game going without people getting aware of it. But my thesis is inflation picks up, but bonds go higher anyway because of all the measures that they are doing to bring liquidity in. And I know that sounds a little counterintuitive, but that's if you follow my reasoning, that's I have a reason for that way of thinking.
No, I agree. That's why I kind of wanted to have your view on here because for me, I have a different view, but at the same time, I was reading yours and I was like, maybe I'm a little too on the side of no cuts because of your reasoning. So I do think that there's many. Once again, it's the Fed. We're trying to predict the Fed. It's the most multifaceted, fake out, say whatever you want to say organization that nobody's exactly going to know what they're going to do until they really are almost about to do it. So it's really hard to figure this stuff out. However, I have to look at how the market's trading. The market's trading like rate cuts are coming. Also another thing to be talking about with utilities usually move when rates start getting cut. Remember 2019, like I remember, and we've been friends for a long time. You remember me trading through 2019, and I was long consumer staples, I was long utilities, and everybody thought I was like a psycho, like everybody's like, what's wrong with this guy? But it was the right environment at that time. Rates just stopped going up. They started to, it's very similar to today. Rates stopped going up. They were talking about the possibility of cutting at some point that year. They didn't do it till way late in the year. However, utilities started to move. So, utilities could also be another thing kind of hinting to us that that's a possibility. I think I did have a chart here of utilities too. Yeah, so there's utilities making a 52-week high. And if you go back, all the way back to the beginning of this chart, that's 2019 and what we were talking about at the beginning. Utilities bottomed in 2018. And nothing nothing bottomed in late 2018. The whole market came down in late 2018, but utilities started to go up and they started to show relative strength. It's the reason we were long utilities. And then you see that crash in utilities at that point. That little crash. It was a very little crash. If you look at the S&P 500 in December 2018, you'll see a very different market. But this little crash that kind of happened, and then we just saw relative strength all year long in utilities, continuing into the crash into 2020 for COVID. Today, we're seeing a very similar thing where we're seeing a new 52-week high. Could there be some form of catalyst that comes up and we get a very similar fake out, where we hit that 52-week high? Like if you look at the left side of the chart, you'll see the first hit on the 52-week high. Then we come back, and then we start moving up. Maybe a catalyst is coming. Maybe utilities are hinting that there's a possibility of some form of a catalyst coming very soon, and we'll see another pullback up here. So, and then that will lead to the next run higher. So once again, it's utilities kind of are ringing the bell. And this is why I always talk about the macro being so important. When you're looking at markets and understanding all the dynamics of markets and the way they work, and you really understand the intricacies of it, and you go, hey, utilities, they're now hitting a 52-week high. The Fed is still talking about the possibility of cutting. Will they cut this year? Maybe, maybe not. However, what's the market telling me? Because what I say really doesn't mean anything to me, or even what I feel. But what the market's doing tells me a lot more than what I'm feeling. Now utilities are making a 52-week high. Now there's a possibility of utilities kind of also saying, hey, we could see the Fed cutting at the end of the year. So that could happen, so that kind of also leads to your thesis too. And also healthcare making a new 52-week high. Same thing, another defensive sector. If we're looking at why, I didn't buy, for example, there'll be somebody on here I know will say, why didn't you buy healthcare in 21 then? Why didn't you buy utilities in 21? Because there wasn't relative strength there. There wasn't, energy was the relative strength. The reflationary sectors were where the relative strength was. Now we're seeing not only are they making 52-week highs, but they're outperforming everything. So it was the same thing if you go back to 2018, 2019, healthcare, very little pullback in where there was a big crash in basically the big Fed pivot that happened on December 26, 2018, which Powell then said, basically, I think it was December what was it, 17th or 18th, he said we're a long way from neutral, and the market crashed. Everything crashed at that point. And then he said, hey, we're neutral 6 days later, 6 trading days later or something, right after Christmas. So that led to that big rally. Healthcare, utilities, consumer staples also were there, and they cut rates into that year, and then that kept going. And then if we go to, this is, oh, I'm back to utilities. 1 second. And then gold miners now. So if we also remember 2018, we go to gold miners, and basically they came down pretty hard into year end. Same thing, long way from neutral. All of a sudden we're neutral. We bottomed in December 26, 2018. We start to rally. All of a sudden we hit a 52-week high in gold miners. Kashop also remembers there's this point here that was, I can remember, that was in May 2019, where I started buying call options heavily in GDX. GDX, basically, we had a band squeeze breakout here at this point in the, it's a weekly chart, so it's squeezed, so it's hard to see. But there was a lot of weeks of consolidation in May 2019. Get a big breakout, continues higher, so we got that pullback, like all the other things. Hit 52-week high, get a pullback, then we just rally like crazy. It all leads to, an environment of the possibility of rate cuts. And then also you're seeing another 52-week high just started now in, actually we're just $1 or so away from hitting 52-week highs in gold miners too. So, I mean, it's just super interesting to just kind of go through that. Solar.
It's the same with solar as well. The solar stocks, I remember you had the TAN ETF and you wrote it for 100% gain back then, the 2018-19 bull run, and kind of looks like the solar stocks have started a similar run this time.
Yes. I mean, it's so the solar stocks are still pretty far away from making it. Let me bring up the chart of that, because it's been interesting. We've had a lot of interest in people talking about the solar stocks. So if you guys are watching, I'm going to bring up the solar stocks now for the TAN ETF. But it was the same thing. We were in that same period of time. Kashop remembers, because it was the same thing. I don't trade based on like my feelings, my emotions, what I do on as a human on Earth. So I just look at where the relative strength is, and I flow into those areas, and I try to do it as easily as I can, and I keep my biases out. But TAN was also one where I was going, okay, well, same type of setup. We're seeing that relative strength kind of happening. We're seeing new 52-week highs. Granted, at that time, I don't think the ETF even had 52-week highs yet, which is kind of interesting. But basically, we saw relative strength there, and we saw it. First Solar is one we can go back a little bit further on. So I was basing most of my data on that at the time. We started to get flag patterns, and then we got just a massive rally to the upside in First Solar, and the TAN ETF. The ETF was what I bought. And so basically that just continued to have this massive rally. And same thing. Then we break down in COVID. We then go back at another 52-week high, and we rally into 2021. So once again, and these trade very similarly, because people talk about it like, it could be like energy, it could be like this, it could be like that. Really, the solar stocks really trade like technology most of the time. This time it didn't. So, if I back test and I go back 20 years, most of the time they move with technology. This time it didn't. So that's kind of saying a fundamental shift that I'm not sure of just yet. But we're very far away from 52-week highs there. I'm not sure exactly of all the fundamentals behind it, why it wouldn't be moving in a way more similarly to technology anymore. But somebody else will probably understand that a little bit better than me. I know that the energy stocks, most of the time, these two things work very, very inversely. So the energy stocks tend to move when the solar stocks stop moving. So once again, if we're looking at it just through that lens, we could go, people are finding more value in the energy stocks over the solar stocks. And a lot of solar, Tesla, all of these things are really based on speculation. What's going to happen in the future? Are we going to move off fossil fuels? Are we going to do this? Are we going to do that? And so it's the same thing when we look at biotechs. Biotechs are in a very similar sense. It's the most risk-on sector in the market because there's really no fundamentals behind it. So this is how you kind of understand like where the market's headed. Is it in a risk-on environment? Is it a risk-off environment? Are we looking at rate cuts? Are we not? And this is why I always say it's so important to understand this stuff, because this is how you understand the landscape. If I didn't have these tools to just go, look at basic charts and be able to put all of these things together, and I did this through back testing. I didn't just do this because I looked at things and thought how they work over time. When people tell me hey, I did this and this passes the eye test to me, that just tells me it's someone who's never back tested anything. And the reason why I say that, I'm not making fun of anybody. I'm saying that because if you've actually back tested, you realize that your eyes suck. That they will lie to you over and over again and tell you things and tell you what you think you know. Most of the time it's wrong. It's the same thing. Like, for example, you could eye test 4-day lows in the S&P 500. If you buy the fourth if it's 4 days down and you buy the fourth day and trade it in a very short amount of time, basically you could sell put options or something like that and sell it within a day or two. This is a very high win rate strategy. But if you just zoom out and look at it, it doesn't look that great. But if you just back test it and use you actually code it or run a system, there's plenty of back testing software these days. You can back test on just about every platform. I think TradingView is free back testing nowadays. TrendSpider is probably the easiest one. I really like TrendSpider because I think everybody could use it. You don't have to go through the pain of learning how to code like I did. And there's even ones that are free that you can back test entire portfolios. It's gotten really awesome for everybody. So back in the day, it started with me writing on spreadsheets and then back testing. And I'm terrible at spreadsheets and I'm terrible at trying to back test everything like that. So it takes me years. Now it's just seconds. So I think TrendSpider, I don't make any money from TrendSpider. I'm just saying, if you are interested in back testing, I think they do 7 days free. You could talk to somebody there and they basically will help you learn how to backtest with them on their own software. So it's a pretty cool piece of software for people, especially if you get 7 days free. And at the worst case, you run a few systems a day and you never use the software again. Worst case scenario. So just putting that out there. But basically, to me, what I'm saying over everything else is, if you really take the time, you backtest software, you understand how these markets move. You look at things like Kashop is talking about and going like, hey, these are reasons why fundamentally I think that this could happen. Then we also put together just on this episode, if that's also a reason why you think they're going to cut soon, then also we have utilities moving. Then also we have consumer staples moving. And those usually move before we see the first rate cut. So put all that together, you kind of have an easy thesis of going, expect rate cuts by the end of this year. Might be later than people expected at the beginning of this year, but they're probably coming some point this year, near the end of the year. And also look at those areas of strength to invest in. I understand the utilities are not sexy. Commodities aren't even sexy. People want very sexy stocks. I know if I talked about individual tech stocks all the time, people would be way more excited. I just don't trade that way. But utility stock, I promise you, making money is sexy. I promise you make, but so buy these things that are moving instead of finding these areas that are lagging. Gold miners, those look great. And that's another thing we could talk about before we get off. I don't know if Steven's ever going to join us today. I know he had a event, or he was getting his hair cut. That's what he was doing. Not an event. I was making him sound cooler than he is. I said he had an event. He's just getting his hair cut today. So he might come on, he might not. But to end on something fun, let's talk about gold miners. I know everybody's interested in it. I know you got a lot of people from your page on here. I'm excited about that. I'm just excited to see how much your page has grown over the last few years. You know, Kashop, I've known him forever. He's a great guy, great analyst, even better friend. So I absolutely love how many people are finally catching on to his work. He's a brilliant dude. So let's talk more about gold miners. See where they, these we just talked about them making a 52-week high, or very close to a 52-week high. And so, what are you seeing in the gold mining space at the moment?
I think the gold miners are going to absolutely print money in this environment. So the thing about the gold miners is that they always find a way to increase their cost. And it doesn't matter whether gold goes up or gold goes down. Over the years, they just find a way to increase their cost structure. And that makes sense because mines are depleting assets. So when you have a brand new shiny mine, you're going to get after the easy stuff first because you've just spent a few $1 billion on capex or even $1 billion on capex. So how do you, and you're taken on debt and everything to finance that. So what do? You need to grow your cash flow. So what do? You go after the easy stuff, the stuff that's easy to mine, easy to crush, which the gold ore that becomes cash quite easily. So you go after that. And that's how these mine plans are constructed. So as the years go by and you've managed to kind of pay all your debts and all your capex is depreciated, that's when you go after the hard stuff because a gold mine is not something that you can just start it and then just shut it down and walk away. It doesn't work like that. So there's a huge cost to reclaiming a mine site, closing a mine site, and then there's the community impact. So what the miners do is because they want to push those costs off as far into the future as possible, they just keep milking the old mine for however long they can keep it going. So what that does is it pushes your operating cost up, and this is the thing with every mining company. So they all have old depleting mines, and therefore the cost structure keeps going up. Now, the one way to get your cost structure down is to do a merger or an acquisition. So you have an AISC, an all-in sustaining cost of say $1,500 an ounce. What do? You merge with the miner which has an AISC of $1,200 an ounce, and suddenly you look better off. So this is what the miners do. Or of course, at some points they just acquire something completely new, build a brand new mine, and use that cash flow and bring their cost down. But otherwise, the costs just keep going up. So what you want to do is buy these gold miners at a time when gold is running so far ahead of their cost structure that they start printing money. So right now, let's say the good gold miners have an AISC, all-in sustaining cost, below 1,500 an ounce, and they are able to sell their gold for 2,400. So that's $900 an ounce in margin, and that goes straight to the bottom line. So when you have these huge margins, these companies gush cash, they build cash on the balance sheet, and what the good companies what they do is they hold on to this cash and they wait, and then when the price troughs again, they use this cash to buy something, and that way the next time gold runs they'll have increased their cost slightly less than the other miners. And this is also where you'll start to see the PE multiples look cheap. So when gold is at 1,800, 1,900, and your costs are 1,500, you're barely breaking even. Your PE looks like Nvidia or some tech stock where it's like 100, 300, some big scary number, and everyone is put off because, well, the PE is too high. Why would I buy a 300 PE mining stock? And some of them may not even have earnings at that stage, but that's kind of when you want to be buying. And when you start to see the PEs compress back to 20, 30, and that's when you know they're all gushing cash, and that's when you know gold is on a good run. That's kind of when you need to start looking at trimming down. And that's mainly because over the few, and this is more of an investment point of view, not a trading point of view, because what I'm saying takes place over quarters. So what happens is you have these huge margins, and those margins will start to get compressed because gold runs ahead of commodities, ahead of big bull run commodities. And what happens is the cost of diesel goes up. And when diesel goes up, operating costs for these companies go up. cost of electricity goes up, and when the unions, most of the mines have unionized workers, when the unions see the company is printing money, they want a bigger cut. So then you have the issue of strikes, you have all these labor issues, and then the governments get involved. So when gold is at a certain rate, they'll agree to a certain royalty structure, and when gold runs higher, suddenly they'll want higher royalties, and those royalties become a permanent higher cost of production for the company. So what happens is when you see those PEs go from 200, 300, or maybe negative earnings to 20, 30, and you see gold running up, that's when you want to kind of slow down. That's the time when everyone is bullish on the gold miners, but that's when you want to slow down. And when you want to take a view on gold, that's when you want to directly just buy gold, because at that point, gold will start outperforming the miners. So the leverage that the miners offer to gold is what you will see right now. In a few quarters, you will see that actually you're better off buying gold. So that's the way I look at the miners. So like to buy, play the cycle the exact reverse of the way the so-called value investors would play it, because the value investors would never buy gold at the gold miners at the bottom because it looks too expensive or they are not making money. Whereas when everything is shiny and neatly packed with the bow and everything looks good, that's when people want to buy. But you have to do the reverse, and it applies to every other cyclical industry. But gold is unique in the sense because, well, with copper or with other metals, they have 25, 30-year-old life of mines. So the way they structure the deals with the governments are not as capricious. So you may have issues, sure, off and on, but Chile is not going to suddenly change its policy, or Indonesia is not going to suddenly change its policy, because all these companies, they make sure they negotiate that stability, whereas gold mines are relatively small capex, so they don't have that kind of negotiating power with the government. And if you look at Newmont is a $40 billion company, and BHP, which is the biggest base metal miner, is a $130 billion company. So you have this huge difference in terms of the clout of those companies. So the gold miners are a little different from the other commodity miners, if that makes sense. So that's kind of how I would look at gold miners. Now, from a trading perspective, it's completely different. So, from a trading perspective, when it's running, when it has the momentum, that's when you're buying it. And of course, then you have your price as your sell signal. With if you're investing in the miners, this is what I would go for. When you have, say, I'm going to be holding this for a few quarters in a row, then this is how I would look at it.
No, I like that because I mean, I just think generally, like you always have to look at things in two different ways, and I think sometimes that gets mixed up when I'm talking sometimes, and I'm trying to be better about that as I'm writing more, is trying to figure out the way to, hey, let's talk about it as a trader and let's talk about it as a possible investment or how the company is going to run. These are very different things. But I also completely agree with you. I mean, I also just pulled up, and not to mention, GDX did hit a 52-week high. I don't know why my chart's saying something different. I have it in my scans. I just looked at the chart over here. It's hitting it. And also to bring up another one, and I don't know how you feel about this company anymore. We haven't talked about it in years. Is AEM? They're also hitting new highs. That's something that's been in my long-term portfolio recently. So, what are you thinking about AEM or any of these large cap gold miners? I am seeing, NEM still kind of underwater, but it's starting to pick up steam. Same with Barrick. Are you seeing any areas that you would say, hey, I'd like to own this over something else?
Absolutely. So if I'm taking a investment point of view, meaning I want to buy something that I'm holding for a few quarters to years, or as long as the gold bull market plays out. So right now I would pick AEM over Newmont and Barrick. So those are the big three, and they're all very similar in terms of market cap. So the reason I would pick AEM is because Newmont has a problem. So Newmont acquired Goldcorp in order to get bigger, and the way the ETFs work is its market cap weight. So you need to get bigger to get a bigger allocation, and that's what they were going for. So they got Gold Corp, and after a few years, they are just kind of telling, "Hey, we screwed up. This acquisition did not work out. We have faced one issue after the other, and we just want to divest those assets." Now, who's going to buy? That's the question, and they are not able to find buyers for those assets. So they're kind of stuck. And all their other operations, it's not going as well as it should be going. So they're kind of stuck in this place where they got big really quickly and now they're trying to trim down. But it's easier to bloat up than to trim down. It's the same with weight loss. I faced this issue. It's like so easy to put on weight, but not so easy to take it down. And it's the same with Newmont. So Newmont has this problem, and until they address this problem, people are going to be very wary of the stock because you really don't know how they are going to address this problem. So, B2 Gold had a similar problem where they had assets in Nicaragua, and Nicaragua had this huge political protest over a pension reform, which did not directly affect their operations, but it kind of did because of the disruptions to supplies and because it's mining. If you're not able to get supplies into your mine site, then you're kind of screwed. So what they did was they just vended down those assets into a new company and kind of made it that company's problem. So they had shares that they could liquidate. So that's the way they addressed it. So if Newmont is able to do something similar, then they may probably be better off in the long run. But if they are not, then they may have to take quite a bit of impairments, and I really don't know how it would work, and this uncertainty is weighing on the stock. Now, when it comes to Barrick, it's a different situation. So Barrick has a problem in Mali, and it's not an actual problem so much as a perceived problem. So they have a mine in Mali, and everyone's talking about changes coming to Mali, which will affect their operations. Now, Barrick has a history of handling local affairs pretty well because you have followed their history. You saw what happened in PNG and how they got that mine restarted, how they have performed in Tanzania, and now they have made good with that government. So Barrick can kind of get through these problems, but the fact that those problems exist, it's weighing on the stock. Now, the beauty with Agnico is Agnico doesn't have any of those issues. So it has one mine in Scandinavia, Finland, uh, and it has most of its mines in Canada, one mine in Australia, and a couple of projects in Mexico. And these are all as stable as they can be in terms of the profile, the geopolitical risk profile, and even in terms of the technical profile. So Agnico has successfully built a mine all the way up in the Arctic. So they are technically very proficient. They don't have any of these risks. So institutions and the big funds, what they're saying is, we don't mind paying a premium for Agnico because we know it doesn't have these problems. We know they are not looking to acquire any other company and get bigger. And so we can hold it as a quality stock without one day waking up to a sudden surprise. Because what happened with SSR mining? So SSR mining ran really hot, and then one day they're like, we have a problem with that leach pad in Turkey, and then the stock crashes 50%. So with Agnico, you'll not have those issues, which is why it commands that kind of valuation. So uh, it's also not the kind of stock which I think will give you those great returns. So if you're looking for leveraged gold, then you may probably not want to buy Agnico because Agnico is not going to give you the same level of leverage. But if the goal is to have some exposure to gold mining and you want to sleep peacefully at night, knowing you're not going to face the situation where one day you wake up and the stock is cut in half, then you go with Agnico. So it's kind of a very unique risk reward situation, which appeals to a lot of the gold investors. And let's face it, most of the gold investors are people in their 40s, 50s, 60s, 70s. In fact, it's mostly 60s and 70s. So they would any day prefer companies like Agnico and Franco Nevada to the higher risk miners. So I think that's what's happening there.
Also, Kashop, I gotta also say, it looks like have you become a secret momentum investor? When we look at these, we got AEMs at 52-week high, but these two are lagging. Kashop secretly has become a 52-week high momentum chaser. I'm just kidding. But that, but it's, once again, it's the mixture of understanding the fundamentals and the prices. If you look at AEM, the volatility is lower. And just simply by looking at it like that, the volatility is lower. It's making a 52-week high. Sometimes when you're making your case like you are, you can always double check the price action just to tell you, like, am I right about this? Because really the price action is telling you exactly what you just said is exactly right, and you're on point. It's not that the price action can tell you that stuff. It's that sometimes it's always good. It's Jesse Livermore said it in his book. I mean, not his book. It's written by Edward Lefebvre, but Reminiscences of a Stock Operator, which is, you pay a premium to get in the market when it's proving you right. Meaning, as it's moving higher, sometimes you're buying as it's moving higher because it's proving you right.
Yeah, absolutely. I think it's kind of a chicken and egg thing, because the way I crafted my logic on Agnico, Newmont, and Barrick has to do with the way the price action has moved. Because if the price action had been like, Barrick has a Mali problem, but investors don't care and they're just blasting shares higher on the Nevada gold mines situation or something. Like they have a new mine coming online in Nevada. So if Barrick is running and Newmont is running and Agnico is kind of stuck, then obviously my read on the fundamentals would be different. Because if you can't match the fundamentals to the price action, then as a discretionary trader, you can't trade. So it's also the way it's a little different than the way the journalists write the headlines, where it's like you really don't know what's going on, but they just want to put something out anyway. But with fundamentals, it's like you're kind of aware and it makes sense. But could you write a different explanation if the price action works out differently? Absolutely, yes. So we were talking about the gold bull market starting in 2020. So April 2020 to August, that's when gold ran. That's when the gold miners ran. And the funny thing is, most of those companies had shut down all their operations during that period. So they were just spending money closing down the mine site, not generating any cash flow, but the stocks were running higher, which makes absolutely no sense. But when you put that into the context of, hey, the Fed just printed $3 trillion and everyone is scared, so they are buying gold, and because they are buying gold, they are buying the miners, it makes sense. Whereas if you just say this company shut down its mine and the stock price doubled, makes no sense. So the way you look at the fundamentals, the way you craft those stories also has to take all the broader factors into account. And I think so. I used to be a hardcore value investor where the first thing nowadays when someone brings up a company like, let's say, First Solar, the first thing I'll do is look at a chart. Earlier, when you bring up a company, the first thing I would do is go look at its financial statement. Start with the balance sheet, look at the income statement, then the cash flow statement, and then kind of take it from there. And I think I changed that approach mainly because with value investing, you're kind of looking at one stock in isolation. You're not looking at it in the broader context. And I think this is where fundamentals also get a bad reputation, because if you're not able to explain the relevant fundamentals, then you really don't have a thesis. And right now, the relevant fundamentals for the gold miners is what's happening with Mali, what's happening with Newmont with the assets, and what's happening with why are investors preferring AEM over the others. And only when you can explain that, you actually have a fundamental thesis. Otherwise, you're just talking, oh, this stock is cheap, this stock is this P, this story and whatnot. And none of it makes sense, because that's not the way an allocator looks at it. And that's not the way, as an investor, you should be looking at it. Because if you look at it this way, and see, I'm talking from experience because I've done this. So start purely from a value investment point of view and say, this stock is cheap, this stock is cheap. And then you build a portfolio of 20 cheap stocks, and all of them suddenly, let's say the oil price goes up, or there's a war in the Middle East. Suddenly, all these stocks, they are correlated to that event, which you have not even modeled, and your portfolio is just going to go for a toss. And if you're doing fundamentals that way, then you're not really not going to make any money, because there's the risk that you see and the risk that you don't see. And the fundamentals in terms of just looking at the balance sheet, the numbers, that's only going to get you so far. It's trying to see past the corners, trying to see what the market is telling you, because when there's a particular way the prices are acting, the market is trying to tell you something. So when you can kind of look at that and incorporate that into your fundamentals, so I think that's where the magic happens. So you have to kind of understand the fundamentals, like a priori, the Misosian way, where you just start without looking at anything, and then you just add layers upon layers of context, and then you iterate. And I think I got to that point now. So, which is why you might look at what I'm saying and ask that question, are you a secret trend follower? Because it absolutely makes sense, because I do incorporate the chart into my analysis. And I think that's the way it has to be, no matter what style of trading you practice. I think that's just the way it has to be.
No, it does. I mean, it's just when you're looking at markets, you get paid from the price action, so you have to look at it. This quote got cut off a little bit, just the E in a period, but it's from Bruce Kovner, and he says, "For me, technical analysis is like a thermometer. Fundamentalists who say they are not going to pay attention to the charts are like a doctor who says he's not going to take a patient's temperature." So, for me, that's always been the go-to for me, because it's like if you don't understand the underlying things that are driving the market, or if you don't understand how you get paid, first off, just how do you get paid as a trader? Well, I get paid if the price goes up or down if I'm short something. So because of that, I have to look at these things. I have to pay attention to these things. And not to mention, there's always, everybody can see the balance sheet. Everybody can see whatever data we all can get. And also, people can mainly see the chart, sure. But the actions of the people that might be saying something different will show up in the chart. If you see AEM moving up in such a strong way, you can also understand that there's probably reasons why. The investors that are the long-term investors obviously see value there. They might even be adding at these points, which is something to go, wow, they're adding at 52-week highs. That's pretty interesting for these people who are normally deep value investors. What are they seeing? Why would they continue to buy here? So you understand those things, and then you can kind of understand where you need to be positioned as a trader. But I have to go. Kashop, let everybody know where they can find you. I know you got the letter out now. It's been really good. I like everything you're putting out. Where can people find you and find your website?
So my Twitter handle is at Kashyap286, is the same one here. My website is kashyapsriram.com. Kashyap Sriram, as in my name that you see displayed here, .com. So please subscribe. So I send out a free newsletter, basically articles, links to articles whenever I publish. And I also run a Telegram group, which is currently it's subscriber only, but feel free to send me a message and I'll get you in. So that's where to find me. So thanks, Jason. This has been pretty amazing.
Awesome, man.
Covering
This is a
agriculture.
good conversation, and I think even for me, like I kind of learned something here. I also feel like we could also the thesis that we kind of put together on the possibility of rate cuts is pretty good. I think that makes a lot of sense on the reasons, at least the market's telling us, and like both of us, the market's saying something. I'm going to be more open to that than any feelings or emotions I could have or anybody else could. I'm Jason at AAO Research. My website's on Substack, AAO Research as well. So Against All Odds Research, you can find all of our stuff on there. Write a lot about commodities, macro markets, stock market sectors, and so on. All right, guys. Thanks for having us and talking to us, and we'll talk to you soon.